Michael Saylor just made a huge announcement, and some of his critics are warning that this one announcement may change the fate of the entire bull market. They say that Saylor's backtracking because the market doesn't want MicroStrategy shares anymore, and so what he's being forced to do is to change his strategy. For years, Michael Saylor had one simple, legendary strategy.
You buy Bitcoin, you hold Bitcoin, you do not sell your Bitcoin.
He had a very basic formula. Raise capital using the MicroStrategy balance sheet and use the capital to buy more Bitcoin, under the premise that, well, you'd never sell. That strategy turned MicroStrategy into the darling of Wall Street. And the weekly purchases supported the Bitcoin market and turned Saylor into a, well, you could say a Bitcoin messiah. But what if I told you that last week, MicroStrategy quietly changed the rules of the game? Some are calling it 4D chess, but the critics, well, they being vocal, and they saying that the perpetual money machine is broken and that Saylor has no more ways to raise money. So what does this mean for the Bitcoin price? What happens if Michael Saylor can't be buying his weekly buys? What does it mean for the MicroStrategy stockholders? What does it mean for the entire MicroStrategy playbook? Today, I'm going to dig deep into the MicroStrategy playbook. I'm going to dig deep into the recent announcement and this apparent change in strategy. And I'm going to make sure that we get all the answers. And I'm going to make sure that we get them first. I'm Crypto Man Run, and I always want you to be first with Alpha. If you want to be first, subscribe to this channel, because on this channel, you never know when content's going to drop. Alright guys, to understand why this is such a big deal, you need to understand one very simple concept. It's called the mNAV premium. Think about it like this. For a long time, investors were willing to pay $280 a share for a share that only represented $100 worth of underlying Bitcoin on the MicroStrategy balance sheet. That extra money is the premium to mNAV. And for MicroStrategy, that mNAV premium has been huge. In fact, this mNAV was Saylor's ultimate superpower. It was called the infinite money glitch. Because with the share price trading so high, he could literally print new MicroStrategy stock, sell it for more than the underlying Bitcoin value, and use the cash to buy even more Bitcoin at the actual market price. This mechanism was genius, and it actually increased the amount of backing for every single share. Absolutely genius. Sell $280 worth of stock, buy $280 worth of Bitcoin for a stock that was previously only backed by $100 worth of Bitcoin. But the big issue here is that every time he issued a new share, he diluted the existing shareholders. And if he carried on, then pretty much there's no way that the mNAV could keep up. So to keep the existing investors happy, Saylor made a promise. And the guidance was crystal clear. MicroStrategy would not sell new stock unless the premium to mNAV was above 2.5x. This was a protection for existing shareholders. It stopped them from being diluted unless they were getting a fantastic price, 2.5 times the mNAV. It was, shall we say, a line in the sand. Well, until now. On Monday, Saylor tweeted a new guideline, and it wasn't the same as the old one. They changed it. They removed that 2.5x protection, and they added a new clause allowing them to sell the stock at lower premiums if it is otherwise deemed advantageous. Advantageous for who though? That's the billion-dollar question. And this brings us to the other side of the story. Because in this story, there's a bull case and there's a bear case. First, let's look at the bull case. This is the argument for the change. The bulls say that this is all about flexibility. I mean, imagine tomorrow there's a big Bitcoin crash and the market drops 30% in a day, and the MicroStrategy stock also drops. And if that happened, the premium would fall to, say, 1.8x. Under the old rules, Saylor's hands were tied. He couldn't use the new stock to buy the dip because the premium was under 2.5x. He'd have to sit on the sidelines and basically watch a massive generational buying opportunity fly by. Under the new rules, he has flexibility. He can pull the trigger. He can issue stock at 1.8 times, 1.5 times premium. He can raise billions of dollars and, well, he can buy the dip and buy cheap Bitcoin while everyone's running for the hills. If the real goal is to maximize Bitcoin per share, then this gives them the firepower to do it in any market condition. They're basically saying, look, you've trusted us until now, trust us to know when it's advantageous to act. And honestly, if you look at their track record, it's a pretty strong argument. I mean, how do you argue returns like this? Since 2020, MicroStrategy is up over 2,700%, while Bitcoin is only up 800%. This strategy works, and it seems like they know exactly what they're doing. But then there's the bear case. The bears are guys like the legendary short seller Jim Chanos.
Jim, welcome. Great to have the most successful short seller on the planet here.
It's a very low bar.
And he's looking at this and saying, this smells of absolute desperation. Why would you remove a rule that gets your stockholders a higher price for their shares unless you can't actually get those prices on the market anymore? Also, why did this rule change come on a week where MicroStrategy only raised $51 million to buy Bitcoin? I mean, after all, for them, that's pocket change. Usually they're buying $500 million, $1 billion a week. The bears are arguing that they're seeing evidence that these premiums that MicroStrategy has been able to attract are no longer there. And with all these other opportunities, other treasury companies and ETFs, there's no reason to pay these premiums anymore. They say that we're entering an era which is the end of the infinite money glitch. And that whatever Saylor does now is actually just a patch. And they're also saying that by allowing stock sales at lower premiums, ultimately it's going to dilute the amount of Bitcoin that each shareholder has. And so what are they doing about it? Well, they're shorting the stock. And as they short the stock, they push the price down and they push the premium to mNAV down. And they're doing it with size. Billions and billions and billions of dollars. So what's the bottom line here? How does this end? Do the shorts get killed, or does MicroStrategy dilute their shareholders to death? Look, technically Michael Saylor did break his promise. The old guidance is gone. But there's a good reason behind it. It gives him the ability to be flexible, and flexible enough to capture the market opportunities. And if you've trusted Saylor as the ultimate financial engineer until now, well, you should probably trust him going forward. Especially when MicroStrategy is about to be added to the S&P 500. Because that would mean that there's a whole lot of tracker funds and index funds that would have to keep buying the stock. And when they do, that's going to push up the mNAV. You also need to remember that markets are dynamic and you need the flexibility to evolve. The game is changing and Saylor is just adapting his strategy. The real test will come when the next big stock sales happen. If they get big premiums, if they sell at 2.5, 2.6, then you know things are good. If they sell below that, well, that number will tell you everything you need to know as to whether this was a genius move for flexibility or the first crack in the Saylor armor. What do you think? Do you think Saylor was wrong? Is he playing 4D chess? Or are the short sellers right? Let me know in the comments, and guys, rest assured, I read each and every one of them. And if you did get value from the show, do me a favor, subscribe to this channel and hit the notification bell. Until next time, trade well, my friends.